5 years ago, I had $0 invested. Today, at 25, I've built a portfolio worth over $100,000. And no, I didn't inherit money or land some high-paying AI job straight out of college. Here's what actually happened and what you can replicate. Let me start with the uncomfortable truth. When I first tried investing, I failed spectacularly. This was March 2020, right when COVID hit and the market crashed hard. The S&P 500 dropped over 30% in weeks. Companies were trading at massive discounts. And what did I do with this incredible opportunity? I gambled it away on options trading. Yeah, not my proudest moment. I was 21, thought I was smarter than everyone else, and watched my money disappear faster than it came in. Options felt exciting, like I was really doing something. In reality, I was just lighting cash on fire with extra steps. After 2 months of that nonsense, I switched to high-yield dividend stocks. At least this felt more legitimate. I was chasing companies paying 10%, 15%, even 20% yields. The cash flow looked amazing on paper, but there's a reason those yields were so high. The stock prices were tanking. These companies were garbage, and I was too inexperienced to see it. By July 2020, I looked at my account and realized something painful. The market had recovered significantly from the March lows. Big, stable companies had bounced back strong, and me? I'd barely made anything. The only reason my account had grown was because I kept depositing money. My actual returns were pathetic. That's when everything changed. I discovered dividend growth investing, and suddenly the pieces clicked. Instead of chasing the highest yields, I focused on quality companies that paid modest dividends but grew them consistently. Think 2% to 3% starting yields, but with dividend growth rates of 10%, 15%, sometimes 20% annually. The logic was simple. A lower starting yield from a great company beats a high yield from a terrible one. Plus, I got 2 ways to win. The dividend income grew over time and the stock prices appreciated. Microsoft became one of my first purchases, then JP Morgan, then Visa. These weren't sexy picks. Nobody's getting excited about Microsoft in 2020. But that's exactly why they worked. I invested $5,244 into Microsoft over time, collected $143 in dividends along the way, sold it recently for $9,453. That's an 80% gain, plus the passive income I collected quarterly. Costco was another winner, put in $4,391, collected $151 in dividends, sold for $6,734. JP Morgan invested $3,112, collected $325 in dividends, sold for $6,250. None of these were home runs. I didn't 10 times my money overnight, but they were consistent, reliable, and they compounded. That's what matters over 5 years. Of course, I had losers too. Realty Income and Visi Properties both underperformed the broader market significantly. I didn't lose money on them, but compared to just buying an S&P 500 index fund, I left returns on the table. Domino's Pizza was another disappointment. Again, not a loss, just opportunity cost. And that's the thing that started eating at me. I was spending hours researching individual companies, managing a portfolio of 20+ stocks, and still underperforming the market. When the S&P 500 was up 24% in a year and my portfolio only climbed 18%, that gap hurt. Because over decades, that difference compounds into hundreds of thousands of dollars. So I started adding ETFs. First, VOO, which tracks the S&P 500. Just the 500 largest US companies in one fund. Simple, diversified, historically reliable. Then SCHD, a dividend growth ETF from Schwab that automatically picks quality dividend growers for me. Eventually, I made a bigger decision. I sold most of my individual stocks and restructured everything. Now my portfolio is 70% VOO, 20% SCHD, and 10% VUG, a growth ETF focused on tech. This setup is simpler, more passive, and frankly, more effective than what I was doing before. But here's what nobody tells you about building a 6-figure portfolio. The strategy matters, sure, the returns matter, but none of it works without the habits that make consistent investing possible. When I moved across the country in March 2022, I was making $55,000 a year. Not poverty wages, but definitely not rich. I drove a 2006 Camry that was fully paid off. Still drive it, actually. I lived in a one-bedroom apartment that cost $950 a month. And for almost a year, that apartment had a bed, a dresser, and a desk. That's it. No couch, no TV, no TV stand. My living room sat completely empty because I was saving every possible dollar to buy my first house. I'd work my remote job, eat at my desk, play some video games, and go to sleep. That was the routine. Was it extreme? Absolutely. Do you need to go that far? Probably not. But that level of focus allowed me to save aggressively while making a modest income. And that's the part people miss when they see a six-figure portfolio. They see the end result, not the months of discipline that built it. Because the uncomfortable reality is this: your investing strategy doesn't matter if you can't consistently invest. And you can't consistently invest if your lifestyle inflates with every raise you get. I tracked every dollar. Rent was $950. Water ran about $25. Electric rarely topped $70. I knew exactly where my money went because I made it a habit to log everything. When you're making $55,000 and trying to build wealth, you can't afford to wonder where your paycheck disappeared to. This isn't about being cheap, it's about being intentional. The other habit that changed everything? Avoiding debt traps entirely. No credit card balances, no car payments, no lifestyle creep disguised as investing in myself. I just lived within my means and stacked cash. Boring? Maybe. Effective? Absolutely. Now let me show you something that might surprise you. My portfolio didn't grow in a straight line, not even close. January 2021, I invested $200. November that same year, $430. February 2022, $253. Then June 2022, I invested exactly $4. $4. Because I was laser focused on saving for a house and couldn't spare more that month. Some months I put in $800. Other months, $75. The amount didn't matter as much as the habit. When I started in July 2020, I was throwing in $25 or $50 at a time. Tiny amounts. But I was building the muscle memory of consistent investing. As my income grew, I kept my expenses flat and funneled the difference into investments. In 2022, I invested $8,168 total. In 2023, that jumped to $21,763. In 2024, I hit $28,000. This year so far, I'm at $23,658. That averages out to about $2,900 per month now, which puts me on pace for roughly $36,000 annually. Compare that to where I started. The progression is everything. But here's where it gets interesting. The early milestones felt impossibly slow. Going from $0 to $10,000 took forever. Then $10,000 to $20,000 dragged on from February 2021 all the way to July 2022. Brutal. Going from $20,000 to $30,000 took until March 2023. Still slow. But then something shifted. The next $10,000 came faster, then faster again. By June 2024, I hit $69,000. 3 months later, $82,000. 2 months after that, $92,000. We had a dip earlier this year where I hovered around $100,000. Then suddenly, April to now, I went from $99,000 to $106,000 to $111,000 to $119,000 to $124,000. In just a few months, I gained $25,000, the same amount that took me years to accumulate initially. This isn't magic, it's compounding. Your early contributions grow alongside your new ones. The larger your base becomes, the more dramatic the swings. A 10% market gain on $10,000 is $1,000. On $100,000, it's $10,000. Same percentage, wildly different dollar impact. That's why starting early matters so much, even with small amounts. And here's what you need to understand about market crashes. They don't scare me anymore. August 2021, my portfolio sat at $18,000. 13 months later, September 2022, it was $17,956. I'd invested thousands of dollars during that stretch and had basically nothing to show for it. The market had tanked, my portfolio looked flat, but I kept buying because long term, the market always recovers. It always trends upward. Your job isn't to time the market, it's to stay in the market. People panic when the S&P 500 drops 30%. They sell everything and lock in their losses. But those same people will sprint to a store when a luxury item goes on sale for 30% off. The logic is backwards. If you believe in the long-term value of the market, a 30% drop is a discount, not a disaster. You're buying the same asset at a cheaper price. When it bounces back, and it will, you benefit massively. I'm not saying market crashes feel good, they don't. Watching your portfolio bleed value sucks. But if you zoom out, every major crash in history has been followed by a recovery. The key is having a long enough time horizon that short-term pain doesn't force you into bad decisions. Right now, I'm sitting just under $125,000 as of the end of August. Even if I never invested another dollar, this amount could double, triple, or quadruple over the next 10 to 20 years. But I'm not stopping. I want it to grow faster. And here's the thing. Going from $0 to $100,000 took me 5 years. Going from $100,000 to $200,000 will probably take less. Maybe 3 years, maybe 2. Because the momentum builds on itself. If you think it's too late for you to start, you're wrong. The best time to start was yesterday. The second best time is today. Even if you can only invest $25 or $50 right now, start building the habit. Once you see results, once you watch your balance climb, you'll get hooked. You'll find ways to earn more or cut expenses so you can invest even more. The hardest part is starting. After that, it's just repetition. Keep buying quality ETFs. Stay consistent. Don't panic during downturns. Give it time. That's how you build wealth. That's how you get to 6 figures. And that's how you set yourself up for financial freedom down the road. I'm starting a new series on this channel called Road to 200K. Every month, I'll break down my investments, how the portfolio performed, and what goals I'm chasing. One of them this year is hitting $40,000 invested. We're averaging around $3,000 monthly right now, so that puts us closer to $36,000 annually. But even clearing $30,000 would be a win. Look, if you're in your 20s and you feel behind, you're not. Most people your age have nothing invested. 0. You're already ahead just by thinking about this. Start with whatever you can afford. Build the habit, watch it grow, then increase your contributions as your income rises. The strategy I laid out works. 70% VOO, 20% SCHD, 10% VUG. Simple, effective, passive. You don't need to pick individual stocks. You don't need to spend hours researching companies. Just automate your investments into quality ETFs and let time do the heavy lifting. 5 years from now, you'll look back and realize the best decision you ever made was starting today. Not tomorrow, not next month. Today. Because time in the market beats timing the market every single time. The portfolio you build in your 20s sets you up for everything that comes after. Financial freedom isn't about getting rich quick. It's about consistent action over years. That's what got me here. That's what'll get you there too.